In the long run, earnings are the main driver of stock prices. What you see on this graph here is the earnings per share of the S&P 500 plotted at a multiple of 15 times earnings going back to the beginning of 2002. And as you can see, the earnings growth has averaged about 8.36% and has been very consistent except for the recession of 08 and 09, as well as the flash crash we saw with COVID. But the big key is stock prices always revert to that value, the orange line on the graph. You can see when the prices were above that, it eventually touched the orange line, followed it down during the recession of 08, traded in reasonable valuations for the next couple of years, got really overvalued for the last several years, and now we're beginning to see a correction again, and people are getting concerned about that. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. It's my great pleasure to welcome you once again to a subscriber request Tuesday. And for this one, I had a kind of an interesting, really kind of a general request, if you will. I had a subscriber ask me if I could show examples of additional stocks that were correcting, especially some of the higher quality dividend growth stocks. So what I did for you, I went and I took the Dividend Aristocrats, those companies that have increased their dividend for 25 or more consecutive years. And I went through the approximately 54 names on that list. And I came up with 33 names, including the S&P 500, which I showcased in the beginning of this video. And I came up with these 33 names that were really the creme de la creme of dividend paying stocks. These are the best of the best, the highest quality blue chip, with the longest streaks of dividend increases available. And what I, been talking about for quite a few years now, frankly, is the fact that these stocks, as good as they are and as great as they are, they were trading at really high valuations that made them uninvestable as far as I was concerned. But that's changed. We have record inflation. We have, price of gasoline at a record high. We have the Federal Reserve talking about raising interest rates to combat that. You have the, Russian-Ukrainian war, and there's a lot of uncertainty out there, and the market has been really acting, pretty badly, and it's created a lot of concern for a lot of people. So, what I showed you in the first graph here, the S&P 500 graph, is that we've seen the S&P begin to correct, but I do want to make a very important point before I leave the S&P and look at individual stocks. Technically, we still have a long way to go. The S&P is still, by the end of this year, could drop easily another 25% before it moved back into fair value territory. So I think, as investors, we should be aware of that. But we've had some of these pristine stocks, 33 of the 54 Dividend Aristocrats, that have begun really correcting after being overvalued for so many years. And so what this really is today, it's a perspective video. I'm going to go very, very quickly through all of these names. I've got them listed in alphabetical order here. And what I'm going to look at, I'm going to predominantly look at operating cash flow because these are dividend paying stocks. And I'm really most concerned about the dividend being covered by the cash flow. And you'll see that each of those do. And again, they all have these long streaks of dividend increases. And, when I put the price on the graphs, just like we saw with the S&P, the stock price tends to trade. In this case, I'm looking at 15 times cash flows. But then, we've had this long-running bull market. Now we're starting to see a correction. There's your first one was Abbott Labs. I'm going to go through these quickly. We see automatic data processing. For all these years, it traded consistently with the normal fair value of 15 or earnings yield of 6.7%. Then we started to get a deviation, and for the last several years, it's been trading at a premium. We're starting to see a correction with all the uncertainty out there. I'm going to go through these very quickly. Albemarle, and again, I'm looking at cash flows here, so I want you to focus on the dividend being covered. That's the white line on this graph being covered by the orange line on the graph, which is the cash flow. You can see Albemarle got way above its cash flow justified value. It corrected. It got overvalued again, and now we're seeing a pretty strong correction in Albemarle, another Dividend Aristocrat. A.O. Smith, you can see that it tracked its cash flow. Actually, it was trading at a discount to its cash flow for most years until we got into 2016, 17, 18. And then we had, an adjustment from 2017 going into the bottom of 2020 where we had the COVID flash crash, and then the stock rallied again, and now we're starting to see it move back into fair value. These stocks are beginning to correct, and the benefit of a bear market, a couple of things I want you to notice on these graphs. Bear markets tend to be relatively short-lived. Bull markets tend to be much longer-lived. And, we're in a point now where we're finally coming into a potential bear market territory. We're not quite there yet, but we're getting close. But you can see these premier dividend growth stocks, these dividend aristocrats, 25 years or more of increasing dividends are beginning to correct. Air Products has actually completely corrected. Notice how the stock was overvalued here for the last couple of years and how flat the performance really was. And now we've had this correction where the stock has dropped, down into its theoretical fair value territory. And this way, I'm basing this on cash flows now. The blue line is technically on this graph, and I do want to focus on that. Technically, to be prudent and conservative and even begin to talk about a margin of safety, we'd want to see this price go down to the blue line. So it's corrected a great deal, but it's not quite at the level yet where I would call it, a margin of safety. But this is a terrific company with a terrific dividend record. And, we're now finally getting a point where it's coming close into fair values. A lot of these names need to be really watched now because you may be able to buy them. Brown-Forman has been trading at ridiculous valuations, but the last year and a half or 2 years, the stock has been correcting. Caterpillar got overvalued based on cash flows. It's corrected. This is one of the more cyclical stocks in the dividend aristocrat list or market. Here's Colgate Palmolive. Colgate Palmolive has really been kind of range-bound for the last several years, but it's now beginning to correct. This is a case where the blue line tends to be maybe a better valuation reference, but it's also an aggressive one because, I would love to see it at the orange line or below. Those would be the times where you had a true margin of safety into the stock. So moving on, Clorox. Clorox had a big kick from the COVID with everybody desanitizing everything. That's kind of shifting away now. The company's, sales and earnings growth have dropped a little bit, and we've seen the stock price following that, and it's corrected to the point where it's getting very, very close to be trading at fair value again. But it's not quite there yet, but it's getting close. So that's, another one. Again, I'm just giving you a high-level look at these stocks. Cintas got, into fair value after the flash crash, rallied again. Now it's beginning to come back. What I'm trying to do is give you a perspective of we've been in this bear market, but we still have a bullish view of these stocks. They are still trading at very high valuations, even though they have corrected rather nicely here in the last month or so. Ecolab is perennially, trades at a rich valuation. It has now fallen dramatically relative to all the issues that I highlighted in the beginning. Emerson Electric has come back down to its orange line. But once again, if you really analyze this graph, and I call this a tool to think with and look at it, to be safe, to have your most prudent purchase, you want to be buying Emerson Electric when it's trading in line with the blue line. It still has a way to go there, but it has corrected at least down to the orange or earnings or cash flow line. Genuine Parts has only begun to correct. I think it's worth looking at this one from a standpoint of operating earnings, just to point out that it does trade at these operating earnings levels, and it is beginning to correct. But if you're looking at cash flow, which is important, then you're looking at dividend coverage, and this company's covered their dividend with cash flow historically. Illinois Tool Works was one of my favorite companies on the planet. Typically trades at a reasonable valuation, got overvalued in 2018, corrected, got overvalued going into 2020, the flash cash corrected it, and now we're starting to see it corrected for the last year and a half or so. It's really been range bound like many of these others. Kimberly Clark has come into fair value based on cash flows, slightly above it, I should say, probably, but only marginally. But if you look at from an operating earnings point of view, we've had a couple of bad years of earnings here expected. Last year was a down year, and we're still expected to have another down year this year. So, Kimberly Clark is one that is giving you almost a 4% dividend yield. It's getting close, although I still don't feel like it has the margin of safety. Leggett and Platt has become into, approaching fair value territory as well. You can see these corrections. Linde PLC has corrected nicely. Its stock usually trades, again, on the blue line at around 13 times cash flow. It's gotten close. It's trading at 15 times, slightly above 15 times cash flow today. I believe the correction process is starting, though. You can see these stocks starting. So again, I'm trying to give you a perspective of how overvalued the market still is, even though we've been through this recent correction. McDonald's always traded at around 14 to 15 times cash flow. It's now still trading at 18 times cash flow, but it has had a nice correction here recently. Medtronic also usually trades at a premium. You can see how when it was overvalued back between the recession of '01 and the Great Recession, how the stock flatlined for almost a decade, and then finally the recession brought it down into what I would call attractive valuation. For the last several years, it's been overvalued, but you can see the pressure for valuation keeps bringing it back down to its theoretical intrinsic value. 3M has corrected into where we actually have a margin of safety in 3M, and that looks just as good when you look at operating earnings as you do cash flows. It does now has entered a margin of safety factor. This stock usually trades at a premium valuation. So, we got 3M, given the quality of the company, we got a nice chance to start looking at 3M with over a 4% dividend yield. That's pretty attractive. From a cash flow point of view, once again, you see the cash flow being extremely covering the dividend. This indicates that the dividend is really safe. PepsiCo is a stock that always trades at a premium to earnings, but normally trades around that 15 times to 16 times operating cash flow, trading at 18 times cash flow, but you can see the correction process has also started with Pepsi as well. Procter & Gamble was always fairly traded at around 15 times cash flow. It's, went up to a premium. It corrected pretty close to being fairly valued again during the COVID crash. It's looking like it's beginning to correct again. So, whether these trends continue or not is time to be told. Pentair, PLC, it's corrected beautifully back down into its operating cash flow. It's actually, theoretically viable. Yields about 1.5%. It's been a good dividend growth story. PPG Industries has really corrected significantly in the last year and a half or so. Again, this is a stock that normally trades below even its blue line, so it still has a ways to go as far as correction to make it what I would consider safe. Roper Technologies, for the last 5 or 6 years, have been very overvalued. We're starting to see a correction once again with Roper from cash flow point of view. Sherwin-Williams, great company, love the story. Operating cash flow really covering the dividends, but you can see the correction process has started. It got to the point where it was so overvalued it had nowhere to go but down. That's Sherwin-Williams. S&P Global has traded in line with its cash flows for all these years, and then more recently in the last 2 or 3 years while we've been in this insane bull market, the stock got really expensive. It got fairly valued almost during the flash crash, but now we're starting to see a correction in Standard & Poor's Global, or S&P Global, which is Standard & Poor's Corporation. Black & Decker has corrected, dividends well covered by cash flows. We see Target, I featured this in a more recent video. Target normally trades at around 9 times cash flow, as you can see as a retailer. It's beginning, it's trading at 12 times, 11.78 times cash flow now, but it's getting a lot closer to being a fair value situation. You get another perspective when you look at it from a standpoint of earnings, how closely this tracks 15 times earnings and how it got overvalued and then has recently, corrected. But once again, operating cash flow significantly covering the dividend. T. Rowe Price is another one that I talked about. Based on cash flow, it normally trades, within reason of its cash flow. It's now trading at a pretty good discount. We don't have forecast cash flow numbers, but you can see it's trading at a big discount to earnings. But I do want to caution you that earnings are expected to be relatively flat for the next several years. So, this would be a speculation. You got margin expansion potential here, or PE ratio expansion, but you don't have a lot of growth in the forecast for at least the next, couple of years. So that's something you want to take into consideration when you're looking at T. Rowe Price. Vanity, VFC, the old Vanity Fair company, traded at a premium for these last several years during this raging bull market. A lot of volatility. I do want you to note that this company changed its fiscal year end from a calendar fiscal year end in 2016 to a March fiscal year end. So the company is now coming into a reasonable valuation range. So we're starting to see a lot of these blue chips. You know, here's West Pharmaceutical. It's been really excessively overvalued for the last several years, moving back into fair value. So, you know, we still see a lot of correction potential to go, but we are starting to see these stocks get more sane again and more reasonable. So this was a subscriber request. This is Chuck Carnival. I hope you enjoyed the video. I just wanted to try to give you an overall perspective and feeling about where valuations have been, what's been going on during this recent correction that we've been experienced, and then most importantly, how much further we might have to go yet before it's fully over. Don't get excited just because these stocks are down. You know, make sure that they're down enough, because the valuations were so extended on many of these companies that even after the correction, they're still trading at relatively high values. Anyway, hope you enjoyed this video. If you did, give me a like, ring the bell, subscribe to the channel if you haven't already. And I look forward to talking to you guys again real soon. Thanks for watching.